Let's first talk about the global macros. Drew Pettit, Director of U.S. Equity Strategy, ETF Analysis Strategy Research at Citi, is now joining in. Drew, great to have you. Thank you very much for joining us on this special day. CNBC TV 18 turns 26. Well, the big event to watch will be the Fed outcome. Wednesday night. So India reacts only on Thursday. But it looks pretty much like a done deal. We're going to get that rate cut. Will it be such a market-moving event? And what would be the signals you will watch, considering that perhaps next year you will be having Kevin Hassett at the table?
Yeah, so first off, I have to start with happy 26th birthday to everyone at CNBC TV 18. And look, just to jump right into it now, like the Fed, 25 basis points for the next meeting is probably priced in by the market. We saw the market price that out leading into December, and that's been priced back in. What we really want to watch out for is that path of cuts into next year. Our economists and team expect 25 basis points, I believe, at the next 4 meetings after December. But the key to us is, do we get those cuts? And are we actually going to get weakness in the U.S. economy, or will it be resilient? If it is, that's a soft landing setup for next year. You should get follow through, not just in the growth side of the market, but some of the cyclicals where earnings growth might actually improve as well. So to us, that soft landing narrative is really key to broadening beyond just mega cap growth in the United States.
Drew, hi, good morning. S&P is up 12% year to date, 17 days to go to wrap up 2025. Typically, I mean, trading activity, etc., trails off, starts to drop off when, Drew? 10, 15 days usually is like a bit of a, low volume part of the year, right?
Yeah, that's pretty typical. And it's funny, everyone talks about seasonality, that you get this rally into the end of the year. In a sense, you're not going to get a lot of new data. So whatever people have been trading, they do continue to trade that way through the end of the year in the United States. To us, look, sentiment's very high. It's very strong. It's been like that for about 6 months now. And that's unlikely to break. That probably means the S&P 500 is going to end up something, I would say, above our base case that we set in mid-year. And it could threaten our bull case of 7,000. Look, somewhere between 6,600 and 7,000 feels about right for the S&P. Again, you probably don't have a ton of news outside of the Fed to really change people's behavior in the last 2 weeks.
All right. Hi, Drew. Good morning, and thanks a lot for the birthday wishes. I thought you'll do a little bit of a jig for us, Drew. You know, it's our birthday. But getting back to the markets, I think your preference was developed markets, right, over emerging markets. Do you stick to that? And where does India feature in? I think you were talking about a better entry point. Do you think that entry point has come about? India has gone through a long period of underperformance, and a bit of consolidation.
So I'll start with the last question first here. Look, we're still neutral on India. The last time I was on, we talked about a really good growth setup. I think you guys touched on that in your open to the show. Look, that hasn't changed. We still believe the growth story. The valuation story also hasn't changed. So you have priced in a really good earnings and growth backdrop for India, so it remains neutral to us. But more broadly, we're actually overweight EM in our global strategy in our allocation recommendations. So look, we pair Europe ex-UK as the cyclical area of the world we want to be overweight. Think there's inflecting growth there. The whatever it takes moment has kind of happened or at least been talked about in Germany, for example. So we like those markets for value. On the growth side, EM is actually a way to get growth and AI exposure at a pretty reasonable price. And we lead the overweight in EM with China and South Korea. When you look at some of the names that screen in our AI at a reasonable price basket, you're going to get names like Baba, Tencent, SK Hynix, and Samsung even. So look, you can get AI at a reasonable price in EM, China, South Korea. That leads our overweight there.
Okay, so China, Korea are overweight on account of the AI exposure. India is a neutral. So your thesis is that tech momentum will continue into 2026. And back to India, What does the currency weakness signal as macro indicators? I mean, that's one of the reasons why India has had one of the worst years of underperformance versus other emerging markets. MSCI India is up 2%, while MSCI emerging market basket is up 27%. That's an underperformance of 25%, and partly on account of currency.
Yeah, look, I'll keep this high level because, again, equity strategist here with you, but the tie together here is perceived tariff risk. And that's relatively high when we look at our models across EM. It's higher for Mexico. It's higher for India. I think the first relief valve for tariff concerns for any trader, global macro traders, is going to be the currency.
Dhruv, we'll leave it there. Thank you very much for coming on. Appreciate your time here on CNBC TV 18. And wonderful speaking with you, as always.
Great seeing you all. Happy birthday once again.
Thank you very much. Thank you.